So if you've been thinking about selling your home to actually downsize, but wondering about the potential tax consequences of such a move, well, the two biggest concerns for the downsizer move are capital gains and property tax increases. Well, the good news is there are actually several ways to legally avoid or minimize tax consequences of capital gains and property taxes when downsizing in California. So, if you are looking to avoid paying taxes legally and while selling a home, I suggest sticking around. I'm Harold Powell, local real estate agent serving Ventura and the surrounding communities. So if you do want to stay up to date on all things real estate for Ventura County, well, I suggest hitting the subscribe and bell icon to be notified of future content. Now, as I mentioned, I'm a realtor and I'm not a tax expert and can't offer tax advice. So really this content should be considered educational, which just means I recommend you work with a tax expert for advice on your particular situation. So let's address the first question of whether you will have to pay capital gains if you sell your principal residence to downsize to, let's say, a smaller property. Here are a couple assumptions on this question. One is that the property is a principal residence, which the IRS defines as a dwelling that the person inhabits most of the time. A principal residence can be verified through utility bills, a driver's license, tax returns, and or the homeowner exemption being filed on your property tax bill. The second is the home must have been used as the family's primary residence in the 2 of the last 5 years. It cannot be acquired through a like kind of exchange in the last 5 years. And the owner cannot have sold another property using the tax exemption within the last 2 years. So once you meet those 2 principal residence requirements, then there are 2 potential exemptions that will apply. Number 1, for those that are individual owners of a home, they are exempt from having to pay capital gains on the first $250,000 of profit on the property. Now, the second option goes to those who are married. Married couples are exempt from paying capital gains on the first $500,000 of profit. Capital gains tax is owed for the profit that exceeds these numbers. Now, one of the mistakes that home sellers make in estimating their profit is they use the loan amount as their basis or starting point when determining the amount of potential gain. The fact is the loan amount has no bearing on how to determine profit or taxable gains. So the IRS only really cares about profit, which means they look at whatever you paid, plus improvements, minus what you sell for, and minus your closing costs. So the good news is that capital improvements that you do to the property and closing costs reduce the potential tax liability. So capital improvements are different from repairs. Improvements are items such as adding solar panels, replacing all the single pane windows with dual pane windows, adding a deck, installing central air, or remodeling the kitchen and bathrooms. Repairs would be things like repairing a leaky roof, painting a room, fixing an electrical issue, replacing a smoke detector. Otherwise, the only time repairs or painting or even staging are considered a selling expense if it was clearly part of the home sale preparation or even part of the closing cost negotiations. Now, no doubt, this is one of the largest tax breaks you can have when you sell your home, and there is no limit to how many times you can use this exemption. The only restriction is that you can only do this every 2-year period. All right, so let's take a look at an example on how to calculate the potential gains and the use of the exemption. So in this example, we use a married couple that, let's say, purchased their home 25 years ago for $500,000. And since they bought the home, they did a kitchen and bathroom remodel, added solar, AC, pool, and some hardscape to their home, which totaled $255,000 worth of capital improvements. Now, they are ready to downsize and sell their home now for $1.4 million. So let's break this down on a spreadsheet so you can really see what's happening here. So we start with the original purchase price, which is referred to as your basis, which is $500,000. And next we add the capital improvements of $255,000 to the basis, which gives us an adjusted basis of $755,000. Now, we move down to the sale price of $1.4 million and subtract off the closing costs of $87,000 and the make-ready selling costs of painting and repairs of $10,000, which gives us $1,302,500. Now, we can determine just how much profit now was realized from the sale of the property by subtracting the adjusted basis from the amount realized from the sale, which is $547,500. And since the married exclusion is $500,000, we can now deduct that from the profit and are left with about $47,500 of taxable gain. Now, this would be taxed using a long-term capital gains rate for federal and ordinary income for California. It's typically going to range somewhere around 30%, give or take, which in this case would be just over $14,000 in taxes paid. So the second consideration of downsizing is really having to pay a higher property tax bill in California. Now, the good news is Prop 19 may allow you to transfer your property tax of your principal residence to the next property you acquire anywhere in California, as long as you meet some criteria. So let's take a look at those requirements. Number one, it applies to homeowners' principal residence only, not a rental property. The owners actually have to be of 55 years of age or older, or permanently or severely disabled. And one other new wrinkle is if your home was destroyed in a wildfire, you can transfer the property tax from that original primary residence. Now, the second criteria to keep your property tax the same is if you buy a property that is equal or lesser in sales price than your current assessed value will be transferred over to the new purchase anywhere in the state of California. Now, the one new twist that was created with Prop 19 is the property tax transfer can also take place regardless of the value change. So you will just have to pay the normal tax rate on the difference in the value of the replacement property from a current property. So let's take a look at examples so you can see what I mean. In this example, we're buying a replacement property of $1.6 million before selling your current home of $1.4 million. And the current assessed value of the home is at $700,000. So the new taxable value of the new home in this case would be $900,000, which equates to $10,800 a year. Now, you can see without Prop 19, your property tax would have been $19,200 a year. So let's take a look at if your replacement purchase happens on the same day or within a year of selling the current residence. The tax assessor in this case uses 105% of your current residence, which in this case adds $70,000 in value. And this in turn further reduces both the taxable value to $830,000 and also your yearly taxes now to $9,960 a year. Now, if you want to try this out, I will add the link in the description alone so you can calculate your own particular situation and estimate. I should also mention that you are allowed to do the property tax transfer up to 3 times in California. So in conclusion, if you are over 55 and ready to downsize, you can potentially avoid or minimize your property tax consequences. So I hope you enjoyed today's video. If so, give it a thumbs up. Thanks.